Should you use an S corporation or a limited liability company when it comes to owning rental real estate? Well, you're going to be surprised because in this video, I'm going to give you 6 reasons why you should never use an S-Corp for owning your rental real estate. And then at the very end, I'm going to show you the one exception that you do not want to mess out on if you're owning rental real estate where an S-Corporation makes a ton of sense. All right, let's get started. Okay, so what are those 6 reasons why we shouldn't be using S corporations? Well, the first one has to do with you can only have one class of stock. Now, if you don't know what the heck I'm talking about, let me show you on the board over here. So when it comes to investing, let's say we set up a limited liability company here and we set up an S corp over here. And we're going to do the exact same thing. We have 2 partners here in these entities, and they're both real estate investors. So in this particular structure, what we've decided to do is we're going to get a piece of property in both of these companies, and we're going to set up the structure as follows, because this individual right here is putting in most of the cash to fund this deal. So we're going to set it up so that this person gets 70% of the profits when the deal sells, and then this person gets 30% of the profits when the deal sells. However, before the property sells, it's going to be generating rental income. And so we want to recognize the fact that this person right here is going to be putting in a lot of work on the day-to-day operations of managing this property, maybe getting it up to where we can rent it out. So we decided that with our ownership structure in these various companies, we want to compensate them. So we're going to split profits, the income that comes from running the property, 50-50. All right, so you can do this. I do this a lot with my LLC operating agreements when I'm working with real estate investors. We'll divide up their ownership interest as follows, but then we're going to change how the income gets divvied up based upon who's doing what. Well, if you're using an LLC, that's okay. You can do that. But if you do that through an S corporation, it will not work, and it will blow your S corporation status and turn it into a C corporation. And now you're going to have major double taxation issues there. So this is why you don't want to use an S corp if you're a real estate investor and you intend to split up the profits different from how the entity is owned from an ownership standpoint. That's a problem right there. Okay, now the second issue that we have in this type of scenario is, let's assume that we're not putting money in to fund this deal here. Instead, in my example, what we're going to be doing is we're contributing a property. So here, this person right here has a rental house. And what they want to do is they want to contribute that rental property to this LLC as follows. And this one person here is going to put in cash to do some rehab work on the property. Well, in that scenario here, if you do use a limited liability company, it works out just fine. However, if you have an S corporation and you're contributing property to an S corporation and your ownership interest right here is less than 80%, then when you contribute this property, let's say the property has a tax basis of $100,000 and a fair market value of $200,000. Well, if this was an entity over here was an S corp and this investor contributed this property to the S corp, they're going to pay tax on the difference between the basis and the fair market value. So they're going to get taxed on $100,000 in making this type of contribution. So this does not work. If you are contributing assets that are appreciated and you don't own more than 80% and you do use an S corporation, taxable. All right, so that brings me to my third reason why we should not be using an S corporation for real estate investing. Okay, so how does that work out? So let's assume that we have, again, a limited liability company here. Here's my LLC, and here is my S corp. Now, I'm not going to have any partners involved in this one here. This is just going to be strictly you. You're the only one here in this type of structure. So you own this one, and you own this one 100%. Now, this property right here, again, let's say the basis in it was $150,000. That's your tax basis. It's now appreciated to $400,000. Okay, so 150, it's now up to 400,000. All right, you decide that you want to refi this property because you got all this equity in there and you want to pull some of that equity out. That's one reason why someone may do this, or they just want to refi it because they had a higher interest mortgage loan. Now, this is residential real estate. And so what we know, working with conventional lenders, when you have residential real estate inside of a business entity, they're unwilling to refinance it in there because, Freddie, Fannie just won't allow it. So what your lender will tell you is that you need to deed the property into your own name, do the refi, and then after the refi is complete, put it back into that company. Now, with a limited liability company, no problem. You can do that. You can move appreciated assets, meaning it's 150, 400,000, it's appreciated by 250. You can move it in and out all day long, non-taxable. But with our little S corporation over here, if you pull an appreciated asset, which means you deed that property to yourself out of your S corporation, and there's any appreciation there, and all you're doing is taking it out to get the refi in, you're going to throw it back in, that's taxable to you. So you'll have to pay taxes as if you had sold the property. So you have $250,000 in gain that immediately becomes taxable when you deed that property out to yourself. So that's a huge problem when it comes for real estate investing with S corporations. It impairs our ability to engage in financing with residential real estate because we can't pull it out without getting hit with the tax. Which brings me to my fourth reason why you should not be using this type of structure for rental real estate. Because some of you are watching this right now and you're thinking, hey, you don't have to worry about that. I don't work with those types of lenders. The types of lenders that I work with will refi the property directly in the entity. So Clint, you're all wet on that one. Find better lenders. Well, tell you what, if you're one of those type of skeptics, let me show you what's going to happen to you from a tax standpoint if you do that. So let's assume that instead of pulling this out, we're going to refi it directly in the entity. So as I showed you earlier, right, you're going to pull out some cash. We're going to pull out, refi this property. We're going to pull $150,000 out. So the property here being pulling the equity out of that deal. Better yet, I'm not going to take out 150. It's a better example if we do this. Let's take out $200,000. So again, what we're talking about here is that you're doing the refi, the cash out refi directly in the name of the entity. You're never taking that property out. Now with a limited liability company, no problem. Refi that deal in the name of the entity, pull out your $200,000. Guess what? It's non-taxable to you to take that $200,000 out. Also, know this, that when you do that, your tax basis, which was $150,000, is now increased to $350,000 because you take what the original basis was plus your debt. So now you've stepped up your tax basis on this entity for future transactions if you were going to sell the property or something like that. Now, on the S corporation, it's not so kind to you. With the S corporation, if you did that same deal, $200,000, and then you distribute it out to yourself, that cash, well, they look at what is your tax basis, $150. You took out $200,000. So right away you have $50,000 in taxable income. Wow, I was a debt. Well, how does it become taxable? Because it's an S corporation. That's why you want to stick with LLCs. The other thing, the double whammy here, is when you pull that $200,000 out, your tax basis is not going to increase for the amount of the debt. So your tax basis down here will stay at $150. In fact, you'll get a basis here for $50. So your tax basis will be $200. So when you later sell the asset, even though you borrowed money, you're going to have a basis of only $200 versus over here it's at $350. So you see there'll be taxes that have to be paid a second time. Bad move when it comes to using these types of entities. Now, my fifth reason why you should not use these types of entity, S corporations, to hold your real estate has to do with much of the structuring that you've probably seen me put together in my other videos. For example, many times when it comes to real estate, we'll have our LLCs structured like this that hold our properties inside of them. And we will oftentimes create a Wyoming limited liability company down here. I'll set up this Wyoming LLC, of which I'm going to be a member, and I'll treat this for tax purposes as a partnership. So I'm going to set this up as a partnership for federal tax purposes. And I'll take my property owning LLCs that are up here, and I'll get them out of my name. In fact, what I'm going to do is I'm going to put my ownership interest down into the Wyoming LLC because I want anonymity. I want to consolidate everything down and just only have one tax return. So there's a lot of reasons why we do this. But if you've got your S-Corp sitting over here that owns a piece of rental property, and you decide, hey, I want to take this S-Corp and I want to drop it under this structure. As soon as you transfer your ownership interest into this LLC right here that I've set up, that will convert your S-Corp to a C corporation. And now you got all those double taxation issues when you go to sell or collect rental income and you trap all your depreciation inside of that business. So S corporations, you just can't transfer the ownership interest to a different entity without blowing it up. So that's a problem. So this brings me to my last point as to why S corporations should not be used for rental real estate. And in this one, it all comes down to what happens when you pass away. So let me get rid of all this stuff here and we'll draw this out. So let's assume that when I pass away, I have a limited liability company here with a property held inside of it. And that property, I bought it, my basis is $200,000 and it's now appreciated to $800,000. Whereas I have an S-Corp with the exact same scenario. And so this is all about estate planning. And when you see this, you're going to go, oh my gosh, how would somebody make such a stupid mistake? Well, it happens all the time. So you've got $200,000 here and it's appreciated to $800,000. Okay, so I pass away. And I am no longer here, no longer living. And I want to leave this to my beneficiaries, my companies, like this. I'm going to leave them my interest. Now, with my limited liability company, the way the estate taxes work is that when you pass away, you get a step up in basis for all your assets. So my property here is stepped up from $200,000 to $800,000, meaning the tax basis for my beneficiaries in that property is now $800K, not the $200K that I held. Meaning that if I sold that property before I died, the day before I passed away, if I sold that property, I would have $600,000 in taxable gain, of which I would have paid about $120,000 in taxes. But I gave it to my kids through my estate, so they don't have that gain because the basis for them is $800K, so they could sell it and not pay any tax. If they don't want to sell it, their depreciation now goes up to $800,000, so now they can reap a lot of tax-free income from this deal. Okay, LLC, it makes a lot of sense then. You want to die with LLCs. Now what about S corporations? This is where it gets ugly. So in this case, you don't receive a step up in basis with an S corporation. So your kids get this company and their tax basis stays at $200,000, what it was in your hands. Now on top of that, so if they're making money, they can't depreciate it here. They can only depreciate it here at the lower level. So they're going to have more taxable income. More importantly, if they sold this property, they'll have $600,000 in taxable gain, which is $120,000 in taxes they're going to have to pay. Can you see the difference here that with this structure, it's much better than using an S corporation? All right, so those are the 6 reasons why S corporations can really screw up your real estate investing. But I told you there's one where you want to use an S corporation. So what is that one scenario where an S corporation makes a heck of a lot of sense? That is where when you want to take your personal residence and you want to turn this personal residence into a rental property. Now, I just spoke with someone not too long ago that told me they wanted to do this, and their idea is that they were going to set up a limited liability company right up here, and they would deed their property into the LLC. And I said, well, why are you doing that? And they said, well, I want asset protection. I'm going to start renting it out through the limited liability company, all the reasons why we do this. I said, all right, so tell me about the property itself. What's your tax basis? They said, our tax basis in the property is $300,000. That's what they bought it for. Okay, great. What is it worth? Let's say in this example, the fair market value of that property is now $800,000. So you see there is a difference here of $500K in unrealized gain. Now, when they transfer that property into the limited liability company, their tax basis will carry over into this LLC. So when they put the property into there, they'll have a tax basis of $300K, not $800,000. So what does that mean to us? Well, it means that if I'm generating income, which I will be from renting it out, then I can only use $300,000 for depreciation purposes. Okay, so with depreciation with real estate, that's one of the reasons why we invest, so that we can depreciate it and offset our rental income. Wouldn't it be better to use $800,000 because then you can offset more income from this deal? I think so. With an LLC, you take your existing tax basis. Now, if we change it, and this is why I'm going to use an S-Corp. Instead, if I set up an S-Corp here for this, only for this type of deal, this is only for this type of deal, and I sell my property to my S corporation for $800,000. Remember, my tax basis is 3. There's a $500,000 of gain there. Now, here are the questions that come up. Well, then I got to pay tax on this. No, you don't. You do not have to pay tax on this when you sell it to your S corporation. And the reason why, remember, this was our personal residence. And when you sell a personal residence, you can take advantage of Internal Revenue Code Section 121, which allows you to sell your personal residence and exclude up to $250,000 per person from taxable income. So I have a husband and wife here, $250,000 for each of them. That's total of $500,000 they can exclude from income. So now by selling it to their corporation is now going to take this property with an $800,000 tax basis. See what happened? We brought it up $500,000. So I put it in there, $800,000 tax basis. Now I can cost seg that property, bonus depreciation out, and offset a ton of income with that company by using this strategy. Now, what always comes up when I explain this to someone, like I did with this couple who I was talking to about using the strategy, the first thing they said to me is, well, Clint, I don't have $800,000 to buy my house, so I like the strategy, but it just won't work. You see, that's self-limiting to think that you need to have the $800,000, because you don't. If you went to buy a piece of property tomorrow, do you have to have $800,000 to buy an $800,000 house? No, you don't. Depending on the type of loan you get, maybe it's 5% down up to 25% down. So those are the same principles we're going to use here. You're going to self-finance it. Now, the details here, you're probably going, what did he mean? Don't worry. I've actually put a video together on this one topic right here on how you can sell your house and turn it into a rental by selling it to your S corporation. I'm going to put the link in the show notes. Be sure to check out that video if you're wondering about how to do the strategy. But that is the one time where an S corporation is going to make sense when you're holding investment real estate. Now, all the other things, 6 things I talked about, yes, those still apply. But when you balance the tax savings versus the other, I'm going to lean more towards this strategy. Now, if I'm not doing this strategy, do not use an S corporation to hold your investment real estate. You'll regret it, or your beneficiaries will at a later date. Hey guys, if you like this video, be sure to hit the like button. If you're not yet a subscriber, now's your time to subscribe. And if you want to learn more strategies like this, I would like to personally invite you to my free live tax and asset protection workshop, where I'll be going through how to protect your real estate, how to structure it properly, use the entities that we talk about, land trust, LLCs, corporations, Wyoming Statutory Trust, Series LLCs. In fact, I'll even talk about how to invest with self-directed IRAs. More importantly, we'll show you cool tax strategies, how you can use those to put gobs of money back in your pocket. I got another link in the show notes below. Completely free event. I bring my power team with me of attorneys and CPAs who will be on there answering your questions. If you haven't yet attended, be sure to check me out on one of my upcoming events. Take care.